There's a dangerous myth that circulates in the world of investing, a whisper that has cost aspiring financiers more money than any market crash. It's the idea that if you could just get a peek at Warren Buffett's shopping list, if you could just know what the Oracle of Omaha is buying, you could piggyback your way to unimaginable wealth. It's a seductive idea, painting a picture of success so simple it feels like a cheat code for the game of money. Just copy the master, and the spoils of victory will be yours. But this idea, this tantalizingly simple path to financial freedom, is not just wrong. It is the most expensive lie in modern finance. Trying to replicate Warren Buffett's returns by only copying his stock picks is like trying to win the Tour de France by buying the same bicycle as the champion. You might have the same equipment, but you lack the engine, the strategy, the years of training, and most importantly, the support structure that makes victory possible. The true source of Buffett's alpha, his enduring, market-crushing advantage, is not found in the quote of his portfolio, it's found in the how. It's buried deep within the architecture of his creation, Berkshire Hathaway. It's a structural marvel, a financial fortress designed to provide a continuous, unending river of low-cost, long-term capital that he can deploy with a patience and a conviction that is structurally impossible for almost any other market participant. Today, we are not going to look at Buffett's shopping list. We are going to steal his blueprints. We will deconstruct the myth of the stock picker and reveal the hidden machinery that truly drives his success. And in doing so, you will discover something far more valuable than a hot stock tip. You will learn how to build your own fortress, how to forge your own unfair advantages, a long time horizon, a patient temperament, and a ruthless focus on low costs that can allow you, the individual retail investor, to achieve something even the most powerful Wall Street titans cannot. This is the path to true alpha generation, the real CEO mindset that separates the permanently wealthy from the temporarily lucky. This is the final promise. The Great Deception, the myth that fuels a billion-dollar industry of newsletters, cable news segments, and online forums, is the myth of the stock picker as a mystical seer. We imagine Warren Buffett in his Omaha office, poring over financial statements with a jeweler's loupe, discovering a hidden gem of a company that no one else has noticed. We picture him making a single, brilliant decision to buy, and then watching the stock soar, making him and his followers rich. This is a story we love to tell because it's simple, it's heroic, and it suggests that genius is a transferable commodity. But it's a fairy tale. To truly understand the fallacy of this idea, we must look not at one of his clean, simple purchases of a public stock, but at one of the messiest, most complex, and most revealing episodes in his career, the crisis at Salomon Brothers in 1991. This was not a stock pick, it was a corporate rescue mission that laid bare the true nature of his power. In the late 1980s, Salomon Brothers was the undisputed king of Wall Street. Led by the brash, cigar-chomping CEO John Gutfreund, famously dubbed the King of Wall Street in a Business Week cover story, Salomon was a bond-trading powerhouse. They were aggressive, arrogant, and fantastically profitable. In 1987, in a move to shore up capital after a failed takeover attempt, Salomon turned to Buffett. Berkshire Hathaway invested $700 million in preferred stock, which yielded a handsome 9% dividend. This was not a purchase of common stock on the open market. It was a private, negotiated deal, a capital injection that gave Buffett a significant stake and a powerful voice, though not initially a board seat. He was a financier, a banker to the bank, not just another shareholder. For a few years, the arrangement was magnificent. The dividends flowed into Berkshire's coffers, and Salomon continued its reign. But inside the aggressive culture fostered by Gutfreund, a cancer was growing. A rogue trader named Paul Moser, head of the firm's government bond desk, began to systematically break the rules of U.S. Treasury auctions. At the time, no single entity was allowed to bid for more than 35% of the Treasury bonds in a given auction. Moser, hungry for dominance and bigger bonuses, repeatedly submitted false bids, using the names of Salomon's clients without their permission, to corner the market. In early 1991, the scheme was discovered. The scandal was catastrophic. This wasn't just a financial misstep. It was a fundamental betrayal of trust with the firm's most important counterparty, the United States government. The Treasury Department, led by Nicholas Brady, was apoplectic. They barred Salomon from bidding in Treasury auctions, a death sentence for a firm whose lifeblood was trading government bonds. The market reacted with sheer terror. Salomon's stock price plummeted. Its credit was threatened. Clients fled in droves. Wall Street's king was about to be guillotined, and it looked like Buffett's $700 million investment was heading toward zero. This is the moment where the myth of the simple stock picker evaporates. A retail investor who had copied Buffett's pick of Salomon Brothers would have been panicking, watching their net worth disintegrate, their only option being to sell at a catastrophic loss. But Buffett wasn't a retail investor, he had a different set of tools. On a Sunday in August 1991, Gutfreund and other top Salomon executives flew to Omaha in a desperate last-ditch plea. Buffett, realizing the scale of the rot but also the underlying strength of Salomon's core business if it could survive, laid down the law. Gutfreund and the top management had to go. They had known about the false bids for months and had failed to act decisively. Buffett, using the leverage of his capital and his unimpeachable reputation, forced their resignations. But that wasn't enough. The firm was still on the brink. In a series of frantic phone calls with Treasury Secretary Brady, Buffett made a personal appeal. He argued that if Salomon collapsed, the contagion could threaten the entire global financial system. To save it, he made an extraordinary offer. He would step in and take over as interim chairman of Salomon Brothers himself. Think about the absurdity of this from a stock-picking perspective. Can you imagine a retail investor seeing a stock plummet, calling up the U.S. Treasury and offering to take over as CEO to protect their investment? It's unthinkable. Buffett flew to New York and walked into Salomon's headquarters, a place rife with panic and despair. He addressed the entire firm via the internal speaker system, his folksy, calm Midwestern voice cutting through the Wall Street hysteria. He laid out a new path, demanding absolute integrity. He famously told them, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." He then went to Washington and testified before Congress, using his personal credibility as a shield for the disgraced firm. His reputation was the only asset Salomon had left. He wasn't just an investor. He was the lender of last resort for the firm's reputation. He restructured management, established new compliance systems, and slowly, painstakingly, rebuilt trust with the government and the market. He saved the firm from annihilation. And in doing so, he saved Berkshire's $700 million investment, which would eventually be redeemed at a profit. The Salomon Brothers affair teaches us the most critical lesson. Buffett's greatest returns often come not from picking stocks but from making deals. He operates as a private equity firm, a crisis manager, and a financier. He gets special terms, preferred shares, and board seats. He influences management. When he invested $5 billion in Goldman Sachs and $3 billion in General Electric during the 2008 financial crisis, he didn't just buy common stock. He received preferred shares with massive dividends and warrants that gave him the right to buy common stock at ridiculously low prices later. You, the retail investor, cannot get these deals. When you see in Berkshire's 13F filing that he owns shares in a company, you are not seeing the full picture. You are seeing the end result of a process that is fundamentally inaccessible to you. You are seeing the bicycle, not the engine. The reason this myth of the guru stock picker is so powerful and persistent is because it hijacks a deep-seated psychological flaw in the human brain, the authority bias. Our brains are wired for efficiency. To navigate a complex world, we create mental shortcuts or heuristics. One of the most powerful is to defer to authority. When we are uncertain, Especially in a field like finance, which feels complex and intimidating, we desperately seek out a guru, an expert, an oracle who can give us the answers and relieve us of the heavy burden of thinking for ourselves. It's an evolutionary trait. For millennia, listening to the tribal elder or the skilled hunter increased our chances of survival. In the modern world, this translates to an almost reflexive trust in figures like Warren Buffett. His track record is undeniable, his wisdom homespun and accessible, his persona grandfatherly and trustworthy. So when he makes a move, our brain tells us the simplest and safest thing to do is to follow him. This cognitive bias creates what is known as the guru effect. We stop analyzing the decision and start analyzing the person. We attribute their success to some innate, magical quality of insight, rather than to a systematic process or a structural advantage. We believe they see things we cannot, and that by simply mimicking their actions we can partake in their success. This is a cognitive trap. It encourages intellectual laziness. Instead of doing the hard work of building our own financial education, developing our own investment strategy, and understanding our own unique financial situation, we opt for the seemingly easy path of cloning. The financial media pours gasoline on this fire. Every quarter, the release of Berkshire Hathaway's 13F filing is treated like a major news event. Analysts dissect every purchase and sale. Buffett buys more Apple. The headlines scream, Buffett sells bank stocks. This creates a sense of urgency and actionability. It implies that this information is a valuable, tradable secret that has just been revealed to you. The reality is that the 13F filing is a snapshot of what Buffett's portfolio looked like up to 45 days ago. You are always looking in the rearview mirror. By the time you read that headline and place your trade, you are weeks or even months behind him. You are not getting his entry price. You are not privy to his reasoning. You are simply reacting to old news, a ghost in the machine. This desire to follow the guru is the path of the 99%, and it is a path paved with mediocrity and disappointment. To break free from the gravitational pull of the guru effect, you need a new mental model. You must replace simple, first-order thinking with rigorous, second-order thinking. First-order thinking is simplistic and superficial. It looks for immediate, direct consequences. It says, Buffett is a genius. He bought stock X, therefore I should buy stock X to make money. It's a straight line, A to B. Second-order thinking is deep, complex, and multifaceted. It asks, what are the consequences of that? And the consequences of those consequences. It forces you to look beyond the obvious and consider the entire system. Instead of just seeing that Buffett bought stock X, a second-order thinker would construct a mental blueprint, a checklist of questions to ask before ever considering a similar investment. First question: what kind of investment is this, really? Is it a purchase of common stock on the open market, just like I could make? Or is it a special deal? A private placement of preferred shares with a juicy dividend and warrants attached, like his investments in Goldman Sachs or Bank of America. If it's the latter, the game is over before it begins. You cannot replicate the investment, so trying to copy the outcome is irrational. Second question: what was his cost basis? A 13F filing shows the number of shares held, but it doesn't show the price at which they were acquired. Buffett may have started accumulating a position in a company years ago at a fraction of its current price. His decision to add to that position today is based on a completely different set of calculations than your decision to initiate a new position at the current market price. His average cost might be $50 a share, and he's adding more at $150. For you, the entry price is $150. It's not the same bet. Third question: what is his motivation for this investment? Is he buying a small stake in a public company because he thinks it's modestly undervalued? Or is he buying the entire company, or a significant enough stake to influence its capital allocation strategy? His purchase of Coca-Cola in the 1980s was predicated on his ability to pressure management to stop squandering capital on ventures like a Hollywood movie studio and instead focus on share buybacks and dividends. He wasn't a passive investor, he was an activist. You, as a retail investor with 100 shares, have zero influence. You are a passenger while he is in the cockpit. Fourth question, how does this single investment fit into the broader structure of Berkshire Hathaway? Berkshire is a unique beast. It's a holding company that owns dozens of wholly owned businesses, from railroads to insurance companies to candy makers. A stock purchase might be a strategic move related to one of those subsidiaries. It might be a way to park a mountain of incoming insurance premiums. Its role in the Berkshire ecosystem might be completely different from the role it would play in your simple brokerage account. This blueprint of second-order thinking is a powerful antidote to the authority bias. It forces you to move from passive imitation to active investigation. It shifts your focus from the person to the process. It's more work, of course. It's much harder than blindly clicking buy, but it's the only way to move from being a follower to being an independent, rational investor. It's the first step in building your own financial fortress instead of trying to shelter in the shadow of someone else's. Let's take a moment to paint a portrait of the investor who ignores this lesson, the investor who lives and dies by the 13F filing. We'll call him the 13F clone. His investment strategy is a ritual of reactive mediocrity. For 2.5 months, he does very little, perhaps dabbling in some stocks he hears about on TV, but he's really just waiting. His entire portfolio management cycle revolves around a single date on the calendar, 45 days after the quarter ends, when Berkshire's holdings are revealed. The day the filing drops, his heart races. He opens the document, his eyes scanning for the big moves. He sees that Berkshire has initiated a new position in a company, let's call it Innovate Corp. The headlines are already blaring. Buffett bets big on tech. The 13F clone feels a jolt of FOMO, the fear of missing out. The master has spoken. This is the signal. He immediately logs into his brokerage account. The stock Innovate Corp is already up 5% in pre-market trading, fueled by tens of thousands of other clones just like him. He doesn't care. He places a market order, buying the stock at a price significantly higher than Buffett's average cost over the previous quarter. He feels a sense of relief and cleverness. He's investing alongside Warren Buffett. He's on the inside track. Then he sees that Buffett trimmed his position in an old stalwart, steady co. Panic sets in. What does Buffett know that he doesn't? The oracle is selling. The smart money is getting out. He immediately sells his own shares of Steadico, likely at a price lower than it was before the news broke, as a wave of selling pressure from other clones hits the market. Now, for the next 3 months he waits. Innovate Corp languishes. It was a good company, but the price he paid was inflated by the very hype he fell for. Steadico, on the other hand, releases a solid earnings report and its stock recovers. He has successfully bought high and sold low, all while believing he was following the world's greatest investor. This cycle repeats, quarter after quarter. His portfolio is a whirlwind of activity, a high-turnover mess that constantly churns but never seems to go anywhere. He's not really investing. He's playing a game of delayed telephone, acting on stale information and paying a premium for the privilege. He has completely abdicated his own judgment in favor of a signal that is distorted by time, price, and context. He is the path of the 99%, the retail investor who is destined for disappointment because he has fundamentally misunderstood the nature of the game. He thinks he's copying a strategy, but all he's doing is generating transaction costs for his broker and tax liabilities for himself. The ultimate, quantifiable cost of this flawed approach is a concept professional traders call implementation shortfall. This is the crucial, often invisible gap between the theoretical return of a strategy and the actual, in-your-pocket return an investor achieves. The 13F clone strategy has a massive implementation shortfall, and it comes from 3 primary sources. First, there's the timing lag. As we've discussed, you are buying up to 3 months after Buffett, and only after the news is public. The Buffett lift, the pop in a stock's price that occurs after his investment is revealed, works directly against you. You are paying the premium that Buffett received. If the theoretical strategy is buy what Buffett buys, your actual implementation is buy what Buffett bought, but at a higher price. That gap is your first loss. Second, there are transaction costs. The constant buying and selling, the portfolio churn, driven by the quarterly filings, racks up commissions and fees. While these may seem small on a per-trade basis, they act like a colony of termites, silently eating away at the wooden structure of your portfolio. Over years, this relentless friction can consume a shocking percentage of your potential returns. Buffett's strategy, as we will see, is characterized by extremely long holding periods, minimizing this corrosive effect. The 13F clone strategy maximizes it. Third, and most devastatingly, are the taxes. Every time the clone sells a winning position to follow Buffett out of a stock, he triggers a capital gains tax event. This is a direct, immediate, and often substantial withdrawal from his investment account, paid straight to the government. It is a forced liquidation of a portion of his compounding machine. Let's quantify this. Imagine two investors start with $100,000 and both earn a gross return of 12% per year. Investor A is a true long-term investor. She lets her winners run for decades, deferring capital gains taxes far into the future. Her $100,000 compounds at nearly the full 12% rate. After 30 years, she has over $2.9 million. Investor B is the 13F clone. He also earns 12% per year on his holdings, but he churns his portfolio, realizing his gains every 2 years. Assuming a 20% capital gains tax rate, his effective rate of return isn't 12%, it's 9.6%. That seemingly small difference is catastrophic over time. After 30 years, his $100,000 has grown to just over $1.5 million. The implementation shortfall, the cost of his flawed strategy, has cost him almost half of his potential wealth. He worked just as hard, he took the same risks, but his structure was inferior. By trying to copy the master's moves without understanding the master's machine, he has guaranteed his own underperformance. He has fallen for the great deception, and the price is his financial freedom. To uncover the true secret, the real engine of Buffett's genius, we have to travel back to 1967, forget Wall Street. We're going to Omaha, Nebraska, to a small, unremarkable insurance company called National Indemnity Company and its sister company, National Fire and Marine Insurance. These companies were owned and run by a man named Jack Ringwalt, a friend of Buffett's. Ringwalt was a sharp, conservative operator, but he was getting older and was tired of the business. One day, he sat down with a young Warren Buffett and, in a remarkably simple conversation, agreed to sell his companies to Berkshire Hathaway for $8.6 million. On the surface, it looked like a modest acquisition of a dull but profitable enterprise. But Buffett saw something that no one else was paying attention to. He saw the key that would unlock a kingdom. He saw the float. This is the single most important concept you must understand to grasp how Berkshire Hathaway works. In an insurance business, you collect premiums from customers up front. You hold this money, invest it, and then, at some point in the future, you pay out claims when customers have accidents or losses. The money you are holding in the interim, the premiums you've collected but have not yet paid out in claims, is called the float. For most insurance companies, the goal is to make a profit on the underwriting. That is, they hope that the premiums they collect will be greater than the claims and expenses they eventually pay out. Any profit from investing the float is just a nice bonus. Buffett flipped this logic on its head. He realized that the float itself was the prize. It was a vast pool of money that didn't belong to him, but that he could control and invest for Berkshire's benefit. It was, in effect, a loan from his policyholders. And the best part? If his insurance companies were run well and achieved an underwriting profit, the cost of this loan wasn't just zero, it was negative. He was literally getting paid to hold and invest billions of dollars of other people's money. The acquisition of National Indemnity was the seed. From that small $8.6 million purchase, Buffett began an obsessive, decades-long quest to acquire more insurance companies and generate more float. He bought Geico, General Re, and others, assembling an insurance empire that is now the largest in the world by this measure. As of the end of 2022, Berkshire Hathaway's insurance float stood at over $164 billion. Let that number sink in. $164 billion. It is a permanent mountain of capital that no one can ever ask him to give back on short notice. The claims are paid out over years, even decades, in a predictable stream. But the total amount of float never shrinks. As long as they keep writing new policies, it constantly replenishes itself. It is the ultimate structural advantage. While other investors have to worry about clients pulling their money in a panic, or banks calling in their loans during a downturn, Buffett sits on a mountain of capital that is not only long-term but that often pays him to use it. This float fortress is the secret weapon. It is the river of cash that he can then use to buy stocks like Coca-Cola or Apple, or to acquire entire businesses like the BNSF Railway. When he bought those stocks, he wasn't using his own money. He was using the collected premiums of millions of people who had bought car insurance from Geico or reinsurance from General Re. His ability to make massive, patient, long-term investments is a direct consequence of this structure. It is not because he is a better stock picker. It is because he is playing a different game entirely, with a different source of capital. He built the bank before he started making the loans. The genius of recognizing the power of the float is rooted in a psychological principle that most people, even financial professionals, fall victim to: mental accounting and the endowment effect. Mental accounting is our tendency to place different values on money, depending on its source or intended use. We might have a vacation fund that we spend freely, but be incredibly frugal with our retirement savings, even though a dollar is a dollar. The insurance industry, by and large, had placed the float in a mental account labeled liability. They saw it as money owed to others, a sacred trust that should be managed with extreme conservatism, typically by investing it in safe, low-yielding bonds. The endowment effect is our tendency to overvalue something simply because we own it. In the inverse, the insurance industry felt the weight of asterisk owing the float, and this sense of obligation constrained their thinking. Buffett completely shattered these mental barriers. He performed a kind of psychological alchemy. He looked at the float and did not see a liability. He saw an asset. He mentally moved it from the money we owe bucket to the money we can use bucket. He understood that while legally it was a liability on the balance sheet, operationally it was an enormous permanent and cost-free asset. This reframing was a cognitive leap that created his entire empire. He saw that the key was not to eliminate the liability, but to manage the mismatch between the liability's long-term predictable nature and the asset's immediate investable potential. He knew that claims from a single year's policies might be paid out over the next 10 years, giving him a decade-long runway to let that capital compound before it was needed. This psychological shift allowed him to see value where others saw only risk. While other insurance executives were focused on minimizing underwriting losses and earning a modest return on a bond portfolio, Buffett was focused on maximizing the amount of float and investing it for the highest possible long-term equity returns. He wasn't in the insurance business to sell insurance. He was in the insurance business to generate permanent capital for his investment vehicle. It's a profound change in perspective. It's like a baker realizing he's not in the business of selling bread. He's in the business of owning real estate, and the bakery is just a way to pay the mortgage. Understanding this psychological principle is key to unlocking your own potential advantages. You have to look at your own financial life and ask, are there areas where I am mentally misaccounting for my assets and liabilities? Am I seeing obligations where I should be seeing opportunities? How can a regular person, someone who isn't going to buy an insurance company, apply this principle? The mental model is what we can call asset-liability mismatch maximization. The goal is to consciously structure your financial life to create a positive gap between the capital you control and the capital you owe, especially in relation to time. You need to find your own personal sources of float. For an entrepreneur or small business owner, this is a powerful concept for capital allocation. It means negotiating ruthlessly for favorable payment terms. You want to get paid by your customers as quickly as possible, collecting your premiums, and pay your suppliers as slowly as possible, delaying your claims. This gap, The cash in your bank account between receiving a customer's payment and paying your vendor's invoice is your business's float. It's interest-free working capital you can use to fund growth, invest in inventory, or seize opportunities, reducing your reliance on expensive bank loans. Michael Dell built his entire computer empire on this principle. He collected cash from customers up front for a computer that hadn't been built yet, then used that cash to pay his suppliers for the parts 30 or 60 days later. The massive float this generated was his primary competitive weapon. For the individual investor, the blueprint involves strategically using the structures available to you. The most powerful source of personal float is tax-advantaged retirement accounts, like a 401k or a Roth IRA. Think about it. When you contribute to a traditional 401k, you get an immediate tax deduction. The government is essentially giving you an interest-free loan on the taxes you would have otherwise paid. You get to invest and compound that entire amount for decades. The claim, the taxes you owe, doesn't come due until you retire, 20, 30, or 40 years later. You are creating a massive duration mismatch in your favor. A Roth IRA is the float concept in reverse but equally powerful. You pay the taxes now, and then all the future growth and withdrawals are tax-free. You are prepaying the liability, so the asset can grow unencumbered forever. This is a structural advantage of monumental importance. Another way to apply this is through a mortgage on a primary residence. While consumer debt is a cancer, a long-term fixed-rate mortgage can be a form of beneficial float. You are borrowing money at a relatively low fixed cost for 30 years and using it to purchase an asset that will hopefully appreciate and whose utility you benefit from immediately. The bank cannot demand the money back early, giving you a stable, long-term capital structure. The key is to see these financial instruments not as isolated products, but as tools for building a personal financial fortress, a structure that provides you with stable, long-term capital that you control. The antithesis to Buffett's float fortress is the path of the 99% debt-fueled consumption. This is the structural tone disadvantage that traps the vast majority of households in a cycle of financial fragility. It is the perfect inversion of the float principle. Instead of getting paid to use other people's money, you are paying an exorbitant price to use a bank's money. Consider the typical financial life. A person gets a high-interest credit card. They buy a depreciating asset, a television, a vacation, a fancy dinner. They are borrowing money at 22% interest to fund immediate gratification. The asset is consumed and gone, but the liability remains, growing and compounding against them. They take out a 7-year car loan. They borrow tens of thousands of dollars, again at a high interest rate, to buy an asset that loses 20% of its value the moment it leaves the dealership. They are funding a guaranteed capital loss with expensive debt. Their personal balance sheet is a disaster. Their liabilities are short-term and high cost, while their assets are non-existent or rapidly depreciating. This is the exact opposite of Berkshire Hathaway's structure. Berkshire has long-term, zero-cost liabilities, the float, funding a portfolio of appreciating, productive assets, stocks and businesses. The debt-fueled consumer has short-term, high-cost liabilities, funding a portfolio of depreciating consumed assets. One is a rocket ship of wealth creation. The other is a black hole of wealth destruction. This isn't a moral judgment. It is a mathematical reality. The person who lives on credit card debt has a negative cost of capital. They are paying a massive tax on their future to fund their present. They have no resilience. A single unexpected event, a job loss, a medical bill, can trigger a catastrophic financial collapse. They have no fortress, only a house of cards. Buffett's genius was not just in finding a source of free money, but in ruthlessly avoiding the trap of expensive money. His personal frugality is legendary, but it's not about being cheap. It's about understanding the mathematics of capital. Every dollar not spent on a frivolous consumer item is a dollar that can be allocated to his compounding machine. Every dollar of high-interest debt avoided is $1 of negative compounding that he doesn't have to overcome. Building your own financial fortress begins with a solemn vow to escape the prison of consumer debt and to start thinking like Buffett, viewing every dollar as a soldier in your army of capital. Let's put this into the language of corporate finance to see the staggering power of this structural advantage. Every company has something called a cost of capital. It's the blended rate it has to pay to finance its assets, a mix of the interest on its debt and the expected return for its equity investors. For a typical S&P 500 company, this might be around 8% to 10%. This means that for any project or investment to be worthwhile, it has to generate a return temps greater temps dines than this 8 to 10% hurdle rate. Now consider Berkshire Hathaway. What is its cost of capital? For a significant portion of its balance sheet, that $164 billion in float, the cost is not 8%. It's not 5%. It's not 0. For decades, Berkshire's insurance operations have been so well run that they have consistently generated an underwriting profit. This means the cost of their float is asterisk dime. They are paid, on average, around 1 to 2% per year to hold and invest this massive sum of money. Let's run a simple scenario. A normal company raises $10 billion in debt at a 5% interest rate to make investments. To break even, they first have to earn $500 million a year just to pay the interest on the loan. Only after that do they start creating value for shareholders. Berkshire has $10 billion in float with a negative 1% cost of capital. This means they are given Nimes $100 million in underwriting profit before they even make a single investment. They are starting the race already on second base. Now let's say both companies invest that $10 billion and earn a solid 10% return, or $1 billion. The normal company's net profit for its shareholders is $1 billion minus the $500 million in interest, so $500 million. Berkshire's net profit is the $1 billion investment return plus the $100 million in underwriting profit for a total of $1.1 billion. That is the direct financial connection. That is the unfair advantage. Berkshire's structure more than doubles the shareholder profit from the exact same investment decision. This is why Buffett can buy entire railroads and utility companies, assets that generate steady but not spectacular returns of 9 to 11%. For a company with a 10% cost of capital, buying a utility that earns 11% is barely worth the effort. For Berkshire, with its negative cost of capital, it's a home run. It is a machine designed to turn good investments into spectacular ones. This is the secret hidden in plain sight on Berkshire's balance sheet. The alpha is not in the stock picks. It is in the architecture that funds the stock picks. The float fortress, this permanent mountain of low-cost capital, directly enables Buffett's second great structural advantage, the ability to weaponize time. In the world of investing, patience is not just a virtue, it is a strategic weapon of immense power. And it is a weapon that almost no one on Wall Street is allowed to wield. To understand this, we need to visit another one of Buffett's legendary investments, his purchase of the Washington Post Company in 1973. It was a dark time for the stock market. The Nifty 50 bubble had burst, the economy was in a recession, and investor sentiment was in the gutter. The Washington Post Company, despite owning one of the most powerful newspaper franchises in the world, along with Newsweek magazine and several TV stations, was deeply out of favor. Its stock had been hammered, falling by nearly half. The entire market cap of the company fell to around $80 million. Buffett, doing his homework, realized this was absurd. He knew the newspaper was a dominant, untouchable franchise in its market, what he would later call an economic moat. He calculated that the company's assets, if sold off individually, were worth at least $400 million, maybe as much as $500 million. He was able to buy a piece of this incredible business for 20 cents on the dollars. He started buying aggressively, investing over $10 million, a huge sum for him at the time, to acquire a significant chunk of the company. But here is the crucial part of the story. The market didn't immediately recognize his genius. The stock didn't turn around and soar overnight. In fact, for the next 2 years, the stock price went nowhere. It even went down. A typical fund manager having made this investment would have been in agony. His clients would be furious. His boss would be questioning his judgment. The pressure to sell the dog stock and move on to something that was working would have been immense. He would have been fired for being right too early, but Buffett had no clients to answer to in that way. His capital came from the float and from long-term oriented partners. He had no quarterly performance reviews. He didn't have to worry about career risk. He was insulated from the market's manic depressive mood swings. His structural advantage, permanent capital, allowed him to execute a psychological advantage, infinite patience. He was happy to sit and wait. He knew the value was there, and he was confident that eventually the price would reflect it. And wait, he did. He held those shares for over 40 years. That initial $10 million investment grew to be worth over $1 billion. That's a 100-bagger, a return of over 10,000%. This kind of return is impossible without a time horizon that is measured in decades, not quarters. He was able to achieve this because the float fortress allowed him to play a different game. Wall Street is playing checkers, trying to win the next quarter. Buffett is playing chess, thinking 10 moves and 10 years ahead. He is engaged in what we can call patience arbitrage, exploiting the market's forced short-termism for his own long-term gain. This patience arbitrage is only possible because Buffett's mind and his corporate structure have been engineered to overcome two of the most powerful and destructive cognitive biases that plague investors: myopic loss aversion and hyperbolic discounting. Myopic loss aversion is a concept from behavioral economics that combines two ideas. Loss aversion is the well-documented fact that for human beings, the psychological pain of losing a dollar is about twice as powerful as the pleasure of gaining a dollar. Myopia means short-sightedness. Put them together and you get a devastating behavioral flaw. Investors who check their portfolios too frequently feel the pain of short-term volatility far more acutely than they feel the pleasure of long-term growth. This constant sting of small losses triggers a panic response, causing them to sell at the worst possible times. Wall Street is a giant engine of myopic loss aversion. The 24/7 news cycle, the constant ticker tape, the quarterly earnings reports, it's all designed to make you focus on the day-to-day noise rather than the long-term signal. Buffett's structure insulates him from this. He famously says he wouldn't mind if the stock market closed for 5 years after he buys a company. He doesn't have a stock ticker in his office. He is structurally and psychologically removed from the daily madness, allowing him to bypass this cognitive trap entirely. The second bias is hyperbolic discounting. This is our tendency to prefer smaller, immediate rewards over larger, delayed rewards. We'd rather have $100 today than $120 a year from now, even though the latter is a fantastic 20% return. We are wired for instant gratification. The entire professional money management industry is built on this bias. Fund managers need to produce good returns this quarter to attract new assets and earn their bonus. They cannot afford to look wrong for long. This forces them to chase hot trends and sell undervalued assets that are temporarily out of favor. They are trapped in a cycle of hyperbolic discounting, always choosing the smaller immediate reward of looking good now over the larger delayed reward of being right in the long run. Buffett's permanent capital structure completely liberates him from this. He has no need for immediate gratification. His time horizon is not the next quarter, it is forever. This allows him to make investments like the Washington Post, investments that require years of patience before they bear fruit, but whose eventual rewards are orders of magnitude greater than anything a short-term approach could ever produce. He is exploiting a fundamental flaw in human psychology that is amplified by the very structure of the financial industry. How can you, as an individual retail investor, replicate this seemingly insurmountable advantage? You can't build a $164 billion float fortress, but you can adopt the mental model that it enables. The blueprint is the 5-year test. It is a psychological pre-commitment device designed to force you into a long-term mindset and shield you from the siren song of market volatility. Before you make any significant investment, whether it's buying a stock, an index fund, or a piece of real estate, you must perform this simple exercise. Take out a piece of paper or open a new document and write down two things. First, write down your investment thesis in 1 or 2 clear paragraphs. Why are you buying this? What is the underlying economic engine of this asset? What do you believe its future looks like? Be specific. I think the stock will go up is not a thesis. I am buying this company because it has a dominant brand, high recurring revenue, and is using its free cash flow to buy back its own shares, which will increase my ownership stake over time as a thesis. Second, and this is the most important part, you write the following sentence and sign your name to it. I am willing to hold this investment for a minimum of 5 years. I will not sell this asset based on market price fluctuations, news headlines, or quarterly earnings reports. I will only consider selling if my original investment thesis, as written above, is proven to be fundamentally and permanently broken. This simple act does several powerful things. It forces you to have a real thesis in the first place, preventing you from making impulsive, emotional decisions. It defines your selling criteria in advance, when you are calm and rational, rather than in the heat of a market panic. Most importantly, it creates a psychological contract with your future self. When the market inevitably crashes and your portfolio is down 30% and every fiber of your being is screaming, "Sell!" you can pull out this piece of paper and remind yourself of the commitment you made. You can reread your original thesis and ask, has anything that is happening today fundamentally broken this long-term case? In 99% of cases, the answer will be no. A market crash, a recession, a bad quarter. These are temporary storms, not a broken engine. The 5-year test is your personal version of Buffett's float. It's a structure, a self-imposed rule that allows you to act with patience when everyone else is panicking. It is the single most effective tool for transforming your time horizon from a liability into your single greatest asset. It allows you to achieve the one thing that gives retail investors an edge over the pros: the ability to wait. To fully appreciate the power of the patience arbitrage, we must examine its antithesis, the path of the 99%, embodied by the modern fund manager trapped in the quote, requote, quote, billionaire. Quote, requote, quote. Imagine a talented, intelligent portfolio manager at a large asset management firm. Let's call her Jane. Jane is a CFA charter holder. She works 80 hours a week, and she is genuinely trying to do the best for her clients. But she operates within a structure that makes long-term success nearly impossible. Her performance is measured against a benchmark like the S&P 500 on a quarterly basis. Her bonus, her reputation, and indeed her job depend on not underperforming that benchmark by too much for too long. Now, Jane does some brilliant research and identifies a company just like the Washington Post in 1973, a wonderful business trading at a ridiculously cheap price. She knows in her bones that this is a 10-year home run. She buys a position for her fund. In the first quarter, the stock does nothing. The S&P 500 is up 3% and her fund is up 2.5%. She's slightly behind. No big deal. In the second quarter, the company has a minor setback, and the stock falls 10%. The S&P 500 is flat. Now her fund is significantly underperforming. Her boss calls her in for a chat. In the third quarter, the stock still hasn't recovered. She is now trailing her benchmark for 3 consecutive quarters. The firm's marketing department is complaining that they can't sell a fund with such poor recent performance. Clients are starting to redeem their shares, pulling money out of the fund, which forces her to sell some of her best assets to meet the redemptions. The pressure is unbearable. She knows the stock is still a brilliant long-term investment, perhaps even more so at its lower price. But she also knows that if she has one more bad quarter, she will be fired. This is called career risk. So what does she do? She sells the wonderful, undervalued business at a loss, and to make up for the underperformance, she buys what's hot. She buys the hot tech stock that's already gone up 100%, the one all her competitors own, not because she believes in its long-term value, but because if it keeps going up, she'll participate in the gains, and if it crashes, everyone else will be crashing with her. She is hugging the benchmark. She has abandoned her own best judgment to save her job. She has been forced by the structure of her industry to buy high and sell low. This is the tragic reality for the vast majority of professional investors. They are not in the business of long-term wealth creation. They are in the business of short-term asset gathering. Their incentives are completely misaligned with their clients' best interests. They are trapped in a game that forces them to be short-sighted, to chase trends, and to act with the herd. This systemic short-termism is the fundamental weakness of Wall Street. And it is the single greatest opportunity for the individual investor who has the fortitude to build a structure of patience. The direct financial consequence of this short-termism is twofold: the tax drag and compounding friction. These are the invisible cancers that devour long-term returns. Every single time you sell a stock for a gain, you introduce friction into your compounding machine. First, you invite the taxman to the party. A portion of your capital is immediately confiscated by the government in the form of capital gains taxes. Let's say you invest $10,000 in a stock that doubles to $20,000. If you sell, you have a $10,000 gain. At a 20% tax rate, you immediately lose $2,000. Your new capital base for reinvestment is not $20,000, it's $18,000. You have willingly shrunk your army of capital. Buffett's long holding periods are a masterpiece of tax deferral. By holding the Washington Post for 40 years, he allowed 100% of his capital to continue working for him decade after decade. The tax liability was a distant, future problem. The power of tax-deferred compounding is one of the most misunderstood forces in finance. Imagine that $10,000 investment again, earning 15% per year for 30 years. If you can let it grow untouched, like Buffett, it will compound to over $662,000. Now, let's say you are a hyperactive trader, a 13F clone, and you manage to make the same 15% return each year, but you sell and realize your gains at the end of every single year. You pay your 20% tax on the profits annually. That 15% gross return becomes a 12% after-tax return. After 30 years, your $10,000 grows to just under $300,000. The tax drag, the friction from your short-term strategy, has cost you over $362,000. You have ended up with less than half the wealth, despite having the exact same stock-picking skill. Beyond taxes, there is the friction of transaction costs and the spread, the small difference between the buying and selling price of a stock. These act like a constant headwind. And there is the friction of reinvestment risk. When you sell a wonderful business, you are now faced with the incredibly difficult task of finding another one that is just as good or better. More often than not, investors sell a great company to buy a mediocre one. Or worse, they hold the cash on the sidelines and miss the next leg of the market's advance. Buffett's structure of patience, enabled by his float fortress, is designed to minimize this friction. His ideal holding period is forever. He wants to buy a great business and let it compound, uninterrupted, for eternity. This is not just a philosophical preference, it is a mathematical imperative. It is the secret to turning a great return into a generational fortune. Buffett's structural advantages of permanent capital and a long time horizon culminate in his third, and perhaps most controversial, strategic pillar, a deep-seated belief in concentrated investing. This is the idea of building an ark, not a zoo. While Wall Street preaches the gospel of diversification as the only free lunch, Buffett and his partner, Charlie Munger, have always practiced the opposite. Their philosophy is to find a handful of truly exceptional businesses, and to bet very, very heavily on them. To see this in action, we must go back to the salad oil scandal of 1963, one of the most formative events of Buffett's early career. American Express was a blue-chip company, a trusted institution. One of its divisions provided financing to companies, taking their inventory as collateral. Their biggest client in this division was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis was running a massive fraud. His company's giant storage tanks, which were supposed to be full of valuable salad oil, were mostly filled with seawater, with only a thin layer of oil on top to fool the inspectors. When the fraud was discovered, Allied crude collapsed, leaving American Express on the hook for what was then a staggering sum of $60 million in worthless collateral. The market panicked. Wall Street assumed that this massive loss would bankrupt American Express. The company's stock, once a darling, crashed by 50%. Investors were fleeing in terror. This was a classic crisis of confidence. A younger, less experienced Buffett might have been scared off too. But instead, he saw an opportunity. His first-order thought was, the company has suffered a huge, embarrassing loss. But his second-order thinking kicked in. Does this fraud permanently impair the core, underlying businesses of American Express, their travelers' checks and credit cards? To find out, he didn't just read the financial statements. He did what he called scuttlebutt research. He went out into the real world. He visited restaurants and hotels, talking to waiters and managers, asking if they were still accepting Amex cards. He went to banks and talked to tellers, asking if customers were still buying travelers' checks. The answer he got was a resounding yes. The customers and merchants didn't care about the salad oil division. They cared about the brand, the trust, and the convenience of the core products. The scandal had not damaged the company's powerful economic moat. Convinced that the market's reaction was pure hysteria, Buffett acted with breathtaking conviction. He took 40% of his investment partnership's entire capital and plowed it into American Express stock. This was not a small tentative bet. This was an all-in move, a bet-the-farm decision based on his deep, investigative work. Had he been wrong, it would have destroyed his track record and his young firm, but he was right. As the company absorbed the loss and the market realized the core business was unharmed, the stock came roaring back. Within a few years, it had multiplied several times over, making a fortune for Buffett and his partners. This story is the epitome of the concentration conviction. It was only possible because he had done the work to develop near absolute certainty in his thesis. And it was only responsible because his capital structure, a partnership of long-term, like-minded investors, could withstand the potential for short-term volatility. He wasn't afraid of looking wrong for a little while because he was so sure he would be right in the end. The financial industry's obsession with diversification is, at its core, a psychological defense mechanism against uncertainty. It is rooted in a bias that Charlie Munger colorfully calls diversification, the practice of spreading your capital so thinly across so many investments that you guarantee mediocre, index-like returns. The underlying psychological principle is the illusion of control. When an investor owns 100 different stocks, they feel safe. They feel diversified. They believe they have controlled for the risk of any single company blowing up. But this is a mirage. In reality, they have simply substituted one risk for another. They have swapped the acute risk of a single bad outcome for the chronic certainty of never achieving a great one. It is mathematically impossible to know 100 companies well. The investor who owns a zoo of stocks knows a little bit about everything and a whole lot about nothing. Their portfolio is not a collection of carefully considered investments. It is a grab bag of hope and ignorance. This illusion of control is deeply comforting. It absolves the investor of the need to do the hard work of deep research and high-conviction decision-making. If you own everything, you don't have to be right about anything in particular. You can just ride the market's beta. This is perfectly fine for a passive investor who chooses a low-cost index fund. But for an active investor, it is a recipe for disaster because it combines the guaranteed mediocrity of indexing with the high costs and brain damage of active management. Buffett's philosophy of concentration is a direct assault on this comfortable illusion. He believes that true risk is not volatility. True risk is not knowing what you are doing. The way to reduce risk, in his view, is to know an enormous amount about a very small number of things. By focusing all his intellectual energy on understanding a few great businesses, he can gain a genuine informational and analytical edge. His control is not an illusion based on owning many things. It is real control based on deep knowledge of a few. This requires intellectual honesty and the courage to be different. It means accepting that your fate is tied to the performance of a small number of decisions. It is a high-stakes game, but it is the only game where it is possible to generate true skill-based alpha, returns far in excess of the market average. To apply this powerful principle to your own investing, you need a mental model that enforces scarcity and discipline. Buffett himself provided the perfect one. He once told a group of business students to imagine that when they graduated, they would be given a punch card with only 20 slots on it. Every time they made an investment decision in their entire life, they would have to punch one of those slots. Once the 20 punches were used up, they could never make another investment again. This is the 20-slot punch card mental model. It is a profound psychological device for improving the quality of your decision-making. If you knew you only had 20 decisions for your entire life, would you make a speculative bet on a cryptocurrency you don't understand? Would you buy a stock based on a hot tip from your brother-in-law? Of course not. You would treat each decision with the gravity and seriousness it deserves. You would do exhaustive research. You would wait patiently for an opportunity that was so compelling, so obvious, that Buffett calls it a fat pitch, a baseball hanging right over the plate. You would only swing at your absolute highest conviction ideas. This model forces you to raise your standards. It shifts your mindset from, "What should I buy today?" to, "Is this one of the 20 best opportunities I will see in my entire life?" This immediately eliminates 99% of the noise and distractions that bombard investors. It encourages you to say no far more often than you say yes. To implement this, you can create your own literal or metaphorical punch card. Before you allocate a significant amount of capital, you ask, "Is this worthy of a punch? Do I understand this business inside and out? Am I prepared to own it for at least 5 years? Is it trading at a price that offers a significant margin of safety?" If the answer to any of these is a hesitant maybe, then the answer is a firm no. You wait. Your capital is precious, but your punch slots are even more so. This model is the practical application of concentration. It ensures that your portfolio, your ARC, contains only your very best ideas. It stops you from accumulating a zoo of mediocre companies that you don't truly understand or believe in. It is the discipline that turns a good investor into a great one. Let's contrast this focused, high-conviction approach with the path of the 99%, the mutual fund menagerie. The average actively managed equity mutual fund in the United States holds around 150 different stocks. Many hold far more. The typical individual investor, in a misguided attempt to be diversified, will often own 4 or 5 of these different funds. The result is a portfolio that is a Frankenstein's monster of diversification. The investor might own a large-cap growth fund, a large-cap value fund, a mid-cap fund, and an international fund. They think they have a sophisticated asset allocation. But when you look under the hood, there is massive overlap. All the funds own Apple, Microsoft, and Google. The investor ends up owning a portfolio of 500 or even 1,000 different stocks, many of which they own through multiple funds. This is not diversification. This is redundant, expensive, and ineffective clutter. They have created what is known as a closet index fund. Their gigantic menagerie of stocks, when blended together, behaves almost exactly like the S&P 500. They have successfully diversified away any chance of outperforming the market. They have paid a king's ransom in active management fees, often 1% or more per year, for the privilege of getting the exact same return as a simple, low-cost index fund that charges 0.04%. It is the worst of all possible worlds. They have the high costs of active management with the mediocre returns of passive indexing. The mutual fund industry promotes this because it is good for business. It's much easier to gather assets by promising safety through diversification than it is to practice the difficult art of concentrated value investing. The menagerie approach feels safe and responsible, but it is a financial trap. It is a structure designed to transfer wealth from your pocket to the pockets of the asset management industry. The 20-slot punch card is the antidote. It forces you to take responsibility for your own financial outcomes. It acknowledges that the only way to earn above-average returns is to be willing to look different from the average. It is a declaration of independence from the fee-laden, performance-chasing mediocrity of the financial herd. The direct financial connection here is the critical distinction between alpha generation and beta chasing. In investment parlance, beta is the return you get from simply owning the market. If the S&P 500 goes up 10%, you get a 10% return. Beta is easy to capture. You just buy a low-cost index fund. Alpha, on the other hand, is the excess return that an investor earns above and beyond the market's return. It is the return generated by skill, insight, and superior decision-making. If the market is up 10% and your portfolio is up 15%, you have generated 5% of alpha. The entire active investment industry is built on the promise of delivering alpha. However, decades of academic research have shown that the vast majority of active managers fail to do so, especially after their high fees are taken into account. Why? Because of the structural issues we've discussed. They are forced into short-term thinking and closet indexing. They are beta chasers in alpha generators, clothing. True alpha is rare and incredibly valuable, and it is most potently expressed through concentration. Think about it. If you have a portfolio of 200 stocks, and one of them is a grand slam, a 10-bagger, its impact on your overall portfolio is minuscule. It's just a 0.5% position. Its brilliance is diluted into oblivion by the mediocrity of the other 199 holdings. But if you have a portfolio of only 10 stocks, and one of them is a 10-bagger, its impact is monumental. It can lift the returns of your entire portfolio for years. Concentration magnifies the impact of your good decisions. Of course, it also magnifies the impact of your bad decisions. This is why it is so feared, and why it requires such deep research and conviction. Buffett's structure, the permanent capital from the float, and the long time horizon it enables, is what gives him the institutional courage to make these large, concentrated bets. He is not trying to be the best beta chaser. He is not trying to beat the S&P 500 by 0.1% every quarter. He is hunting for elephants. He is trying to generate massive, game-changing alpha by making huge bets on the few opportunities where he believes he has an almost insurmountable edge. This is the financial endgame of building the fortress. The structure enables the strategy. The float enables the patience. And the patience enables the conviction to concentrate. It is a seamless, interconnected system for beating the market. So we have deconstructed the myth of the stock picker and uncovered the true sources of Buffett's power: the float fortress, the patience arbitrage, and the concentration conviction. The final, most important question remains: how do you, the individual retail investor, forge your own fortress? You cannot buy national indemnity, but you possess structural advantages that even Warren Buffett, with all his billions, would envy. The key is to recognize them and build a system around them. The genesis of this idea can be found in Buffett's earliest days, long before he was a global icon. When he started his first investment partnership in 1956, he didn't take money from just anyone. His first partners were his family and close friends. He wrote them letters every year, explaining in simple, clear terms exactly how he was going to invest their money. He told them he would not tell them what he was buying. He told them he might have years of underperformance. He told them he was focused on long-term results, not short-term pops. In essence, he was structuring his investor base to be an unfair advantage. He was filtering for patience. He was creating a partnership of people who were philosophically aligned with his long-term, rational approach. He knew that the quality of his capital was just as important as the quantity. This is the ultimate lesson. From day one, Buffett has been a master architect of structure. And you can be one too. Your fortress will not be made of insurance companies, but of something far more powerful and far more difficult for the professionals to replicate: your own behavior. The ultimate structural advantage, the bedrock upon which your entire financial fortress will be built, is your temperament. Buffett has famously said that the most important quality for an investor is temperament, not intellect. You need a temperament that derives pleasure from being apart from the herd, not from being with it. You need a temperament that is steady in the face of panic and skeptical in the face of euphoria. This is your greatest and most inaccessible edge over Wall Street. A fund manager is a slave to the emotions of his clients. When the market panics, his clients panic, and he is forced to sell. When the market is euphoric, his clients are greedy, and he is forced to buy overpriced assets to keep up. He is structurally chained to the madness of the crowd. You are not. You have no clients. You have no quarterly reviews. You answer to no one but yourself and your long-term goals. You have the unique ability to be a true contrarian, to be greedy when others are fearful, and fearful when others are greedy. This is an advantage of almost infinite value, but it is not easy. It requires you to consciously fight against your own worst instincts. You must overcome the herd bias, our deep-seated psychological need to do what everyone else is doing. When your friends are all bragging about the fortunes they are making in a hot new stock, it takes immense discipline to stick to your own boring, well-researched strategy. You must also overcome action bias, the feeling that you must always be doing something. In investing, very often the most profitable action is inaction. Sitting patiently on your hands while your great businesses compound is the true secret. But our brains crave activity. We feel we need to tinker, to trade, to react. Cultivating a calm, patient, and contrarian temperament is the hardest work you will do as an investor. But it is also the most important. Your behavior, not your stock picks, will ultimately determine your financial success. To translate this idea of a behavioral edge into a practical framework, you must build your personal fortress on 3 foundational pillars. These are the 3 advantages that every single retail investor can harness, advantages that the professionals are structurally barred from using. Pillar number 1 is the time horizon advantage. You are not managing hot money. You are investing for a goal that is likely decades away: retirement, financial freedom, a legacy for your children. This means you can and must think in terms of 5, 10, 20, or even 30 years. You can buy a great company that is temporarily out of favor and happily wait 5 years for the market to recognize its value. A professional cannot. You can ignore the noise of quarterly earnings reports and focus on the long-term trajectory of a business. A professional cannot. You must formally commit to this. Write down your financial goals and the timeline you have to reach them. Make this timeline the ruler against which you measure every decision. When the market crashes, ask yourself, does this short-term event impact my 20-year plan? The answer will almost always be no. Pillar number 2 is the temperament advantage. This is where you actively work to become a more rational investor. It means turning off the noise. Stop watching financial news channels that are designed to provoke an emotional response. Stop checking your portfolio every day. Set up a system. Automate your savings and investments so they happen without your emotional involvement. Dedicate time to financial education, reading books, not headlines, to build the conviction that will allow you to stay the course during storms. Your goal is to become what Nassim Taleb calls anti-fragile, someone who is not just resilient to chaos, but who can actually benefit from it. A market crash is not a disaster for you. It is a once-in-a-decade buying opportunity. Pillar number 3 is the cost advantage. This is the simplest and most certain way to improve your returns. You must be absolutely ruthless in minimizing the 2 great destroyers of wealth: fees and taxes. This means choosing low-cost index funds as the core of your portfolio. Or, if you choose to own individual stocks, it means adopting a low-turnover, buy-and-hold-forever strategy to minimize transaction costs and defer taxes for as long as possible. The few percentage points you save in costs each year might not seem like much, but over an investing lifetime, they compound into a fortune. These 3 pillars, a long time horizon, a rational temperament, and a low-cost structure, are the steel beams of your fortress. They are not as sexy as a hot stock tip, but they are infinitely more powerful. To fully grasp the importance of building this personal fortress, we need only look at its antithesis, a persona that has become tragically common in the modern market: the Robin Hood gambler. This individual represents the polar opposite of a structured, patient investor. Their entire process is designed for maximum fragility and wealth destruction. Their time horizon is not measured in years but in minutes. They are day trading, chasing meme stocks, and buying risky options contracts that expire in a few days. They are not investing, they are gambling. Their temperament is driven entirely by social media hype and FOMO. They buy a stock not because they have studied the business, but because they saw it trending on Reddit or being pumped by a financial influencer. They are pure herd behavior, constantly chasing the last hot trend, and they are always the last ones to the party, buying at the peak and selling in the panic. Their cost structure is a nightmare. While the commissions may be free, they are paying in other ways. They are trading on margin, using high-cost leverage that magnifies their losses. They are constantly crossing the bid-ask spread, which is a hidden transaction cost. And because of their frantic trading, they are generating a mountain of short-term capital gains, the highest taxed form of investment income. The Robin Hood gambler has no fortress. They are standing in the middle of a financial battlefield with no helmet, no armor, and no plan. They are a cautionary tale. They are the 99% who are lured in by the promise of easy money and are systematically stripped of their capital by the unforgiving mathematics of the market. Their failure is not a failure of intelligence, but a failure of structure. They have chosen to play a game that is rigged against them, and the result is predictable and tragic. The direct, quantifiable financial cost of failing to build a personal fortress is a phenomenon known as the behavioral gap. This is one of the most important and well-documented findings in all of personal finance. Year after year, studies by firms like Morningstar and Delbar show the same depressing result. The average investor's actual return is significantly lower than the return of the mutual funds or ETFs they are invested in. Think about that. The investments themselves do fine, but the investor who owns them does terribly. Why? The gap is purely a result of bad behavior. It is the cost of chasing performance, of buying high in moments of euphoria and selling low in moments of panic. The Dalbar study has shown that over a 20-year period, this behavioral gap can cost the average investor several percentage points of return times per year. Let's make that concrete. If a simple S&P 500 index fund returned an average of 10% per year, the average investor in that fund might only earn 7% or 8%. That 2 to 3% annual gap is the direct financial penalty for having a weak structure and a poor temperament. Over a 30-year investing lifetime, the difference is staggering. An investment of $100,000 growing at 10% becomes almost $1.75 million. Growing at 7%, it becomes just $761,000. The behavioral gap has cost this investor nearly $1 million. It has cost them their financial freedom. This is the final, crucial realization. The single most powerful lever you have to control your long-term financial destiny is not finding the next Apple or Amazon. It is closing your own personal behavioral gap. It is building a fortress of rules, habits, and mindsets that protect you from your own worst emotional impulses. This is the true path to beating the market. You don't beat it by being smarter. You beat it by being more disciplined and better structured. You have made a significant investment of your time today, and in doing so, you have acquired a powerful mental tool. You now understand the fundamental architecture of Warren Buffett's genius. You can see, perhaps for the first time, that the legend is not built on a magical stock-picking formula, but on a meticulously engineered fortress of structural advantages. You've moved beyond the novice who chases stock tips and have begun to think like an architect, to see the hidden blueprints behind the performance. This understanding alone places you in the top tier of investors. But understanding this architecture is only the first critical piece of the puzzle. A fortress, no matter how strong, is a defensive structure. It protects capital, it provides the runway for victory, but it does not, by itself, win the war. The fortress of permanent, patient capital is useless without a ruthlessly effective offensive strategy for deploying it. Knowing how Buffett gets his money is not the same as knowing how he decides where to put it. How did he identify the targets? How did he develop the mental models to value a simple business like See's Candies, or a global behemoth like Coca-Cola, when others saw them as mature and boring? That is a completely different set of skills, a different layer of the mental arsenal. The video that is now appearing on your screen is the next piece of the map. It is the crucial bridge that connects the structure you've just mastered with the strategy you must now learn. It links the why of Buffett's permanent capital with the how of his capital allocation. It is the blueprint that the architect needs to begin construction. What you have learned today is the foundation. That video is the first floor. You have made a choice to elevate your thinking, to move beyond the simplistic myths that trap the 99%. You have chosen the path of the architect, the strategist, the CEO of your own financial future. But an architect with no blueprints is just a dreamer. Your ascent has just begun. Complete your mental arsenal. Claim the next tool that is essential for your journey. Click the video and continue building.